Mastering risk management in investing, your path to financial security. Imagine standing at the edge of a vast ocean. The waves are unpredictable, sometimes gentle, sometimes fierce. You can either dive in recklessly, hoping to ride the waves, or carefully chart a course to navigate the waters. This choice, between diving in recklessly or navigating wisely, is the essence of understanding the difference between investment and speculation. Stay with us, and we'll reveal the key to managing risk in investing, ensuring you can sail smoothly even through the stormiest markets. Welcome to Nouveau Riche Investor. Today, we delve into the timeless wisdom of Benjamin Graham's The Intelligent Investor. We'll explore how to manage risk through knowledge and research, why a disciplined approach is essential, and how these strategies can secure your financial future. Benjamin Graham, often called the father of value investing, emphasized that successful investing is not about avoiding risk, but about managing it effectively. His insights, shared in The Intelligent Investor, have guided many to financial success, including Warren Buffett, who called it the best book on investing ever written. So, how do we manage risk in investing? Imagine you're the captain of a ship. The sea is full of unseen dangers, rocks, storms, and unpredictable waves. Your job is to navigate these waters safely. In investing, this means understanding the risks, preparing for them, and making informed decisions. The first step in managing risk is through knowledge and research. Graham stressed the importance of thorough analysis. This involves delving deep into a company's financial statements, understanding its business model, and assessing its long-term potential. Risk management in investing requires a disciplined approach. Here are the key principles Graham suggested. 1. Diversification. Spread your investments across different assets to minimize the impact of any single loss. Diversification is like having multiple lifeboats. If one fails, you have others to rely on. 2. Margin of safety. Always invest with a margin of safety. This means buying stocks at a price below their intrinsic value, providing a cushion against market fluctuations. 3. Long-term perspective. Focus on long-term value rather than short-term gains. This reduces the temptation to make impulsive decisions based on market trends. 4th, regular review. Continuously monitor your investments. Adjust your portfolio as needed based on changing market conditions and the performance of your assets. Warren Buffett's success is a testament to the power of these principles. By diversifying his investments, maintaining a margin of safety, and keeping a long-term perspective, Buffett has navigated the market successfully for decades. Think of these strategies as a lighthouse guiding you through the unpredictable seas of the stock market. They provide a steady point of reference, helping you make informed decisions and manage risk effectively. Managing risk is not about avoiding it, but about preparing for it and making informed decisions. By following Graham's principles of thorough research, diversification, maintaining a margin of safety, and keeping a long-term perspective, you can navigate the markets with confidence. These strategies help build a resilient portfolio that can withstand market volatility and grow steadily over time. Remember, successful investing is about securing lasting wealth, not chasing quick profits. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor. Stay tuned for more videos where we'll explore each of these concepts in detail. Until then, happy investing.